Ever dream of retiring early? Maybe sipping something cool on a beach? Or maybe financial freedom just means like not stressing about bills.
Right.
Either way, this deep dive is for you. You've given us the Young Investor Society's Stock Investing 101. Looks like you're ready to crack the code of building wealth, and we're here to help you navigate it.
It's more than just picking stocks, isn't it?
Right.
This ebook smartly points out that we're all investors in a way.
Yeah.
Every dollar we spend or save is a choice about the future.
Okay, let's unpack that. It's like this. Imagine someone said, here's $100 today, or a brand new Mercedes next year. Which one makes your brain light up more? That tells you something.
A very tempting Mercedes, to
Oh,
be sure.
right.
But your gut reaction reveals if you're wired for instant gratification or the potential of long-term gains. That's the core difference between spenders and investors that this ebook highlights.
And that's where the stock market comes in. Now, I don't know about you, but seeing those charts with like huge gains over decades sometimes feels like magic, right?
It's the magic of compounding.
Yeah.
And the ebook does a fantastic job of illustrating its power. Think of it this way. Even a small difference in yearly returns, say 3% versus 9.8%, can mean a difference of over $1 million on a relatively modest investment over 50 years.
Wow. Okay, that's a pretty compelling argument for diving into the world of stocks. But the stock market can seem intimidating, right?
Yeah.
Like, what even is a stock?
The ebook uses a great analogy. Owning a stock is like owning a piece of your friend's company. You're not just buying a ticker symbol, but a slice of a business you understand.
Okay, that makes it feel less abstract. But I've heard people say the market is driven by emotion. How do you navigate that?
That's where Mr. Market comes in.
Okay.
A character the ebook uses to personify the market's mood swings.
Right.
Imagine him as that unpredictable business partner, sometimes euphoric, other times in despair.
Yeah.
His emotions impact stock prices even if the company itself hasn't changed much.
Ah, Mr. Market, the ultimate drama queen. So how do you avoid getting swept up in his emotional roller coaster?
The ebook emphasizes looking for a margin of safety.
Okay.
Those moments when Mr. Market's having a fire sale on a fundamentally strong company.
Like snagging your favorite designer jeans on super sale. But how do you determine a company's true worth amidst all the noise?
The ebook boils it down to two key questions. How much will profits grow, and how long can they sustain that growth?
Those seem like pretty crucial questions.
They are. The ebook uses Apple as a prime example. Even tiny changes in their projected profit growth or the lifespan of that growth can significantly change your valuation.
Okay, that makes sense. But don't all companies face competition? How can you be sure a company's success is built to last?
That's where the concept of an economic moat comes in. Think of it like a castle.
Okay.
Some businesses have defenses that are really hard to breach, protecting their profits.
I love that analogy. So what kind of moats should investors be looking for?
The ebook outlines four main types.
Okay.
First up, brand recognition. Take Coca-Cola, for example.
Right.
People pay a premium for their products even though there are cheaper alternatives out there.
Makes you wonder if their secret ingredient is really just masterful branding. What else you got?
Then there are switching costs. Ever tried switching banks?
Ooh.
It can be such a pain that many people just stick with what they know.
Oh, tell me about it. Switching banks is like doing your taxes a necessary evil. All right, what else should we add to our moat checklist?
Next up, network effects. Think platforms like Google or Facebook.
Right?
The more people use them, the more valuable they become, making it tough for competitors to catch up. And finally, we have the low-cost advantage, where companies like Walmart leverage their size to negotiate lower prices and offer lower prices to consumers.
So these moats are like superpowers in the business world.
Yep.
They give companies a competitive edge, even when times are tough. But how do we actually go about finding these moat-worthy companies?
It's all about becoming a bit of a business detective. The ebook suggests starting with your own life. Think about the products you love, are loyal to, or would find it difficult to replace.
So if I can't live without my morning coffee from a certain place, that company might be worth a closer look.
Exactly. That deep-rooted loyalty often indicates a company has a strong moat. Beyond that, the ebook talks about stock screens.
Stock screens. Sounds like something Wall Street gurus use. Can you break that down for us?
They're basically filters for the stock market. You set certain criteria, like a minimum return on equity or a specific level of revenue growth, and the screen generates a list of companies that meet those standards.
So it's like having a custom shopping list for stocks.
Exactly. And the ebook even provides some examples of specific metrics to look for, like 5-year return on equity or PE ratio. And hey, don't be afraid to borrow ideas from successful investors. Reading reports from respected fund managers can spark ideas and lead you to companies you might have overlooked.
All right, so let's say you've done your research, identified a company with a solid moat, and you're ready to invest. What happens next?
Here's where it gets really interesting. You need to develop your investment thesis.
An investment thesis. Now, that sounds official. What exactly does that entail?
It's basically your personal WHY for owning a stock.
Okay.
It's what you believe about the company's future that the market might be missing.
So it's about digging deeper than just the numbers and forming your own well-informed opinion about a company's potential.
Precisely. It's about staying rational in a market, often driven by emotions.
Makes sense. So it's about cutting through the hype and forming your own informed opinion about a company's potential. But how do you actually go about creating this investment thesis? So how do you go from this company seems cool to a rock-solid investment thesis?
It starts with asking the right questions. The ebook suggests thinking about what you believe about the company's future that the market might be overlooking. Are they sitting on a game-changing product? Is their brand poised for a comeback?
So it's about finding those clues that everyone else is missing, like being a financial Sherlock Holmes.
Exactly. Once you have a working thesis, it becomes your guiding light, especially when the market throws those inevitable curveballs.
Because, let's be real, the market can feel like a roller coaster sometimes. How do you avoid making impulsive decisions based on those daily ups and downs?
That's where your investment thesis acts as your anchor. When news hits, good or bad, you check it against your thesis. Does it fundamentally change the company's long-term potential, or is it just a temporary blip?
So if a competitor launches a new product, but it doesn't really threaten the core of your thesis, you don't hit the panic button.
Precisely. You see it for what it is.
Yeah.
Noise that doesn't impact the company's long-term prospects. But if news emerges that directly challenges a key element of your thesis, say their star product is flopping, that's a sign to investigate further.
So it's all about filtering the noise and focusing on the signals that truly matter.
Exactly. Now, to build that thesis and filter that noise, we need to delve into the world of financial statements. This is where the rubber meets the road. Those numbers tell the story of a company's performance.
I'll admit, I used to find those balance sheets and income statements a bit intimidating.
Right.
But the ebook did a good job of demystifying them.
They're not as scary as they seem once you understand the language.
Right.
The ebook focuses on the 3 core financial statements: the balance sheet, the income statement, and the statement of cash flows.
It's like a financial health checkup for a company, right?
Precisely. Each statement provides a different piece of the puzzle. The balance sheet is a snapshot in time, showing a company's assets, what they own, and liabilities, what they owe.
So it tells you where they stand financially at that moment. What about the income statement?
Think of it like a video, showing how much revenue they generated over a period, their costs, and ultimately their profit or loss.
And then we have the statement of cash flows, which tells us how much cash a company generated from its operations.
Right. It tracks the movement of cash, showing how much came in and how much went out. This one is particularly important because it cuts through the accounting jargon and shows the actual cash a company has on hand.
Speaking of cash, the ebook also talks about free cash flow, a key metric that even Warren Buffett looks at.
It's a powerful indicator of financial health,
Yeah.
showing the cash left over after a company covers its expenses and invests in future growth. Essentially, it's the cash they have available to reward investors or reinvest in the business.
Interesting. So how do we use all this financial information to determine what a company is actually worth today?
That's where the concept of intrinsic value comes in. This is like uncovering hidden treasure, what a company is truly worth, regardless of the current stock price.
Ooh, I like the sound of hidden treasure. Tell me more.
There are 2 main ways to determine intrinsic value: the discounted cash flow, or DCF, model, and the relative valuation method. The DCF model might sound intimidating, but it's about forecasting a company's future cash flows and then discounting those back to their present value.
Discounting. Why do we need to discount those future cash flows?
Because a dollar today is worth more than a dollar tomorrow. We account for the fact that money can earn more money over time. Imagine it like this. If you were offered $100 today or $100 a year from now, which would you choose?
I'd definitely take the $100 today. Time is money, right?
Exactly. So with the DCF model, we're essentially figuring out what those future cash flows are worth in today's dollars.
That makes sense. But I imagine forecasting future cash flows involves a bit of guesswork, right?
It does. You have to consider historical trends, industry dynamics, market share, competition, and even broader economic factors. The ebook actually provides a spreadsheet tool to help you work through this process.
That's super helpful. So it's not about predicting the future perfectly, but making informed estimates based on solid research. What about this other method, relative valuation? So relative valuation is like comparing apples to apples in the stock market.
Exactly. You look for similar companies in the same industry with comparable business models, growth potential, and financials. Then you use their valuations as benchmarks. For example, let's say you're looking at a software company and its price-to-earnings ratio, or PE ratio, is much lower than its peers. That could be a sign that it's undervalued.
So it's about spotting those relative bargains in the market.
Precisely. But remember, it's not as simple as just comparing a single metric. You need to consider industry trends, company-specific risks, and even management quality. The ebook has a helpful chart showing typical PE ratios for companies based on their growth prospects. It highlights how even within the same industry, valuations can differ.
It's like those real estate shows where they compare houses in the same neighborhood, even if they look similar. A million little things affect the price.
Exactly. The ebook also wisely suggests using both the DCF model and relative valuation together. They each have strengths and weaknesses, so combining them gives you a more complete picture.
Got it. So we've got our tools, our thesis, and we're ready to start picking stocks. Any final tips before we unleash ourselves on Wall Street?
The ebook stresses the importance of an investment checklist, and I couldn't agree more. It's easy to get caught up in the excitement, but a checklist helps you stay disciplined and avoid common pitfalls.
Like it stops you from buying that hot stock tip your brother-in-law told you about at Thanksgiving.
Exactly. Your checklist should include questions tailored to your investment style and risk tolerance. Things like, does this company have a strong economic moat? Do I understand their financials? What's my exit strategy if things go south?
It's like having a set of rules to keep you from making emotional decisions.
Precisely. Think of it as your financial safety net.
This deep dive has been incredible. We've covered so much ground: the power of compounding, understanding Mr. Market, identifying those all-important economic moats, crafting an investment thesis, decoding financial statements, and even valuing companies like the pros. Talk about a crash course.
It's a testament to this ebook's ability to break down complex concepts into digestible and actionable steps.
So for our listener who's ready to take their investing journey to the next level, what's the one key takeaway you'd want them to remember?
Knowledge without action is like a car without an engine. It's time to put what you've learned into practice. Start researching companies, developing your investment approach, and building a portfolio that aligns with your financial goals.
Couldn't agree more. Investing is a journey, not a destination. Embrace the learning process, be patient, and remember that even the most successful investors started right where you are now. Happy investing.